Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, active or passive, you're just curious about the multifamily industry, maybe you invest in it, been doing it for a decade, or maybe you've just been working in the industry, property management, you're on the operations side, welcome. Thank you for being here. Appreciate you taking the time to spend a little of your hard-earned time with us. Myself, Spencer Gray, I'm the president of Gray Capital, as well as Griffin Haddad. He leads up producing the Gray Report, as well as working on the capital markets team. Man, we are at an interesting point in time, not just for multifamily, but the world. And we're going to be talking about more of that today, where things are going, where they've been, and how to make sense of it. We're at war. Oil is above $110 per barrel, and that impacts renters, it impacts inflation, and it impacts interest rates. Now, we talked about it several weeks ago, saying this conflict is going to go on longer than anyone in the media was talking about. And I'm not trying to pat ourselves on the back, but we were right. And the conflict continues. So what does that mean for multifamily? What should you to get ready? And the actual operational playbook that we are implementing here at Gray Capital. Give you a quick sneak peek, being defensive on operations, but going all in and being aggressive on acquisitions. We're also going to talk about the absolute crazy POS piece of legislation that is passed the Senate, that's going through the House right now. The unintended consequences are just so paramountly insane. Got to talk to your congressman to stop this thing, because it is absolutely going to crush supply and increase rents. Even though that might be a good thing for a multifamily investor, it's not good for the housing stock of the United States. And I'm an American. I want to have more housing here in the United States. So we're going to be talking about that, the legislative front. We're going to be talking about war and peace, how that impacts multifamily, and then a little bit of a sneak peek into our own operational playbook here at Gray Capital. And we may even tease an upcoming opportunity. Stick around for this whole episode. It's going to be a blockbuster. Let's get into it. Welcome back to the report, Griffin. I'm so happy to be back in the seat. You maintained the helm. You had the con last couple weeks.
Yep.
Crushed it. Had Matt on last week. You guys did a great job. You held it together when I was having technical difficulties, when I was out spring break in Costa Rica. Carl Whitaker was on the show in studio. Did a great job. How's it been the last 2 weeks?
The show must go on. I am so excited to have you back in the seat. Pressure's off my shoulders for the intro. And since you're listening to this point of the podcast, you just heard the most epic intro of all time. Thank goodness I didn't have to do it again this week. You nailed it. I'm doing awesome. Like you said, we've got a lot of very cool things happening here at the office. Having Carl Whitaker in office 2 weeks ago was really awesome. I was a little nervous prior to him showing up. Chief economist of RealPage.
Yeah.
Can I hold a conversation with that guy, or can I interject in a conversation with Carl and have him still respect me and my knowledge for our industry? I walked in the building, just a normal guy. I mean,
Such
just
a nice
super
guy.
easygoing, very easily let my guard down around him just to have that conversation. So that was very fun. And then introducing Matt to the world as a new member of Gray Capital last week, also very exciting. I think it's something that we should do more here on the Gray Report. Is just bring in some of our team members, those that are at home in the car or at work listening. They don't necessarily know them as well as they maybe should. So it's great to get Matt in front of the camera. I also learned a lot about Matt just personally on that interview. So he's got a kid named Griffin. I didn't know that.
There you go. It's a good
amazing.
name. It's a good name.
And you're back from vacation. So, I mean, it's a great thing to be able to go on family vacation. You took the whole family basically to the beach, but coming back into the office at a time here at Gray Capital where, the burners we're in full thrust.
Yeah, exactly. Yeah, full thrust, full gas, to the burners, full throttle. And in a time where it's confusing, and I think some people would do the opposite, pump on the brakes.
Mm-hmm.
And in fact, we were seeing that happening right now in real time. We're seeing operators pump the brakes, put pencils down for a variety of reasons. A lot of uncertainty, a lot of changes in the market. I mean, that's a lot of what we're talking about today. Mm-hmm. It's the current market conditions, but I mean, when treasuries spike, when oil moves, above $110 a barrel, which I believe it is today, we can check right this second. Yeah, WTI crude is up 0.5% today at $112 and change, basically $113 It begs a lot of questions of, again, the sustainability of what we're doing. And that we're also on the back of, we had a really solid jobs report on last Friday, kind of at face value. I think we're 130,000 jobs, plus or minus. I think some negative revisions. The number will probably be revised down again, but the unemployment rate ticked down just a little bit. So there's a lot to say that the underlying fundamentals in the economy, even though it's been confusing for the last couple of years, it's been resilient. I don't think anyone would say that like this economy is qualitatively good in totality. There are areas that are good. There's areas that are really struggling, but it's been resilient, and only because of that resiliency, we're in a position to not like immediately fall into a recession. We're coming into this part of the market part of the year with, again, healthy employment. We're not really adding any jobs. I mean, besides the 130 that were created, we're basically been kind of flat with, especially like the private sector and public sector. So that's concerning. But again, it's the duration of the conflict. And there's so many things that come out of the Strait of Hormuz. And that's what we talked about on the show a couple weeks ago, is that if that strait stays closed for so long, it's just a bottleneck. And I mean, the reason why we saw inflation back during COVID wasn't really to do with the virus. It was supply chain bottlenecks. And now maybe it's not the whole world, but the Strait of Hormuz is significant. And even though it may be 15 to 20% of the world's oil, all those downstream effects, and the market still can gap up and price that risk in. And it doesn't look like the market has fully priced some of the risk in. I think Wall Street has been in a position to say, we're going to get through this. There's going to be some resolution, with the idea that neither side can sustain this economically for too long. I think Iran is saying, you may have the watches, but we have all the time. And they believe that they may be able to wait us out longer than we can wait them out. That is why, again, by the time this episode comes out, it will be dated. But Trump's saying that Iran's going to die tomorrow. What does that mean? Are we going to take out all the bridges, all the oil infrastructure? And then what are those the downstream effects? Because obviously Iran's going to respond. And taking the kinetic conversation out of it, just how does that impact multifamily? And we're looking at an absolute surge in construction costs because of this. Aluminum, steel, oil goes into the price of everything just about. So all these materials used to build these assets are getting more expensive. Interest rates haven't gone down, they've gone up. So your cost to carry, which was already a major resistant point to new development and new supply, now all the input costs are also going up. That means it's going to cost a lot more money, thousands of more dollars per unit to build a new project. And it was almost impossible to have these deals penciled to begin with.
Correct.
You either have to have, special incentives or such a compelling story, or you just have so much money you just don't care.
Right. Or you have the land that you're sat on for 10 years.
Yeah, you have some crazy cost basis, and the city is saying we'll give it to you, and we'll guarantee it, and we'll give you all the money to build it.
Sure,
those deals will get done, but not all of them.
Yeah, there's not very many of those.
There's some. Public-private partnerships, especially a lot of municipalities, realize housing is a critical issue.
Yeah,
housing supply, affordability, it's top of mind. Let's do something about it. And unfortunately, this gets us into the next topic, is on a national level, the do something about it is going to do the opposite. And it's a classic case of any time the Republicans and Democrats all get together and agree on something, you should be really skeptical and scared.
Right.
And second guess it. Because Donald Trump has gotten together with Elizabeth Warren, and they've come up with some half-baked plan to do something with housing that all it's going to do is appease small portions of either of their base that know nothing about housing.
Right. It's the lack of knowledge of the downstream impact, the latent impact of this bill if it does pass in the House. It's like nobody even looked into it, or nobody cared to look into it, or maybe they did and they just didn't appreciate the effect. But they're trying to make housing more affordable. At the end of the day, they're reducing supply. the demand will still be there. So what does that do to price?
Goes up.
Goes right up. So they're doing the inverse of what they're intending to do.
Yeah. And, we'd like to think that it's just good intentions, just unintended consequences. And maybe they just didn't take the time. But, I'm not going to sit here and say that they're dumb people. And so usually they're somewhat intelligent. And so it's either, is it negligence? Is it purposeful? Again, I tend to think, I try to see the good in people and assume that people do have the right intentions. They just are going about it the wrong way. And the consequences of their actions end up being, they're unintended. This, though, is, and you want to get into this piece?
Yeah, let's do it. I think it's worth talking about and spending some time on. It's going to impact our business. It also is going to impact the overall affordability of the housing market across the United States. And so I think it's very pertinent.
Yeah, 100%. So what we're talking about here today is the 21st Century Road to Housing Act, and it passed the Senate by a vote of 89 to 10. This is from NIOP, which is a great organization, advancing major housing legislation to the House for a vote. And this is quoting, in large parts, the bill is intended to increase the supply of affordable housing by, among other things, streamlining regulatory reviews for housing projects, good, promoting housing and opportunity zones, totally fine, raising federal housing administration, FHA loan limits, good, and supporting manufactured housing. Now that sounds pretty good, and that's how it was originally drafted. But unfortunately, continuing on with the NIOP piece, unlike the prior House-passed version of the legislation, the Senate included a restriction on the purchase of single-family homes by institutional investors that own 350 homes or more. I don't know any institution that owns like 350 homes. You either own thousands or you own none. And anyway, which a lot of the people who own 350 homes are kind of larger mom and pop. I mean, mom and pop is, I think, not a great descriptor, but they're a private, small business, essentially.
I would say it's a sophisticated investor that owns
a sophisticated investor.
350 homes.
Yeah. But it's often almost exclusively not an institution. However, we're describing institutions these days. And again, who's this idea? Who gets to decide who gets to own what? Anyway, so this has been a demand of President Trump and Senator Elizabeth Warren. The Senate language, however, added a requirement that owners of build-to-rent homes would be required to sell those homes to individuals within 7 years. How arbitrary could that be?
Right.
The sad
random number.
It's so random. Why not 5? Why not 4? Why not 10?
Yeah.
Like, it's like the idea that's like, who needs a second home? It's like, who are you to put a number on how many homes someone can have?
Right.
Like, you can only wear one pair of shoes.
This specifically impacts the build to rent segment.
Yeah.
Obviously there's some single family home institutional owners that are renting these single family homes out to tenants that either long term, short term. Doesn't really matter, but the BTR segment here is really impacted as that's kind of really taken off the last, let's just call it 3 years, the BTR segment.
It's the fastest growing segment in housing.
Right. And this is effectively going to snuff it out, I think, largely very quickly because these developers of these build to rent communities now it's becoming illegal to own 351 of these. And so name a company or developer in this build to rent space that owns 349 of those.
Yeah.
Very little. If not any.
I agree. Not very many at all. I highly recommend. Jay Parsons did a great episode on this. His podcast, The Rent Roll with Jay Parsons. Go take a listen to it. He did a great job of breaking this down as well. But what is happening? But again, it's not past the House yet. It hasn't gone to reconciliation. Just past the Senate, which is typically the harder hurdle to get past. It could pass the House, assuming it comes to the floor for a vote and whichever package it gets wrapped into.
Yeah.
But it's already having a chilling effect on the industry. Developers are pressing pause. They're setting plans down, and they're not building anymore. And the only solution to high prices is high prices to bring on more supply.
Yeah.
Because high prices are triggered in the market, you need to build more. So the prices are there. The developers are saying we need to build these BTR because the BTR assets because the demand is there. It's this great sweet spot in the market. You've got individuals who are maybe, let's say you're in your mid 30s or late 30s.
Across the entire age spectrum from young adult to
really
retiree.
Anybody. Yeah. I mean, and if you have your family, it's like I'm not in a position to buy a house right now because I don't have $50,000 to put down, but I want a backyard. I want to have my own space that's like a home, because I want to
Right.
raise my kids, my dog, and whatever. That now is becoming illegal to be able to provide that type of lifestyle.
Yeah.
And we need all the housing we can get. Luxury, affordable, middle market, like bring it on, let's build it.
Mm-hmm.
And so you're tweaking around the edges on like, we're going to reduce this regulation, this red tape. Good. That's all good.
Mm-hmm.
But like you're taking one step forward and like 6 steps backwards.
Entirely. So the idea of this is, hey, we're going to put a restriction on the number of single family homes that these institutions can own. These developers or institutions that come in through and they build these, let's just call them large scale build to rent communities that may have upwards of 200 individual structures or individual homes, maybe a little less, 150, 75, you name it. But they've got these large portfolios where this is saying that if you build this house in, let's just use round numbers, 2025, you now have to sell that in 2032 in year 7. So you have this
forced to.
Yeah, it's this forced sale of an asset in that market of that year, whether it's an up year or down year in the market. And then, I think that who's the buyer on the end? Is it the tenant in the home that's going to buy that house, or is it just a single family that wants to move in? I think it drastically kind of forces their hand and makes it largely disincentivizes their opportunity to go and build these communities and provide housing to Americans.
Yeah, it makes no sense.
On the inverse side of it, in regards to our business,
Yeah.
and let's just call it renters by necessity or renters by choice, individuals that would otherwise want to rent a single family home that cannot find one or one at the current price point, it pushes them into these multifamily communities.
It's great. It's great for our business. I mean, it's great for existing assets. You're reducing supply, which is going to push up rents. Which again, they're trying to do the opposite.
I was going to say, then now housing for everybody, really, truly everybody, becomes more expensive because the college graduate that has a roommate that's renting, at a gray residential property here in Indianapolis, if all of a sudden those build to rent communities are no longer being built, now the price of a multifamily community unit goes up because the demand is higher.
Exactly. Yeah.
It seems like they just haven't really taken a look at the long-term effects of this in regards to trying to make housing more affordable for Americans. It's in fact doing the opposite. And it's not just for those that are looking for a single family home to rent. It's those that are also renting 1, 2, 3 bedroom apartments.
All right, let's just watch her speech. Let's watch Elizabeth Warren, hear what she has to say. Let's see if her argument makes any sense.
Going to have to explain to the American people why they don't want to see us build more housing and have that housing in the hands of homeowners to make that happen. So thank you very much, Mr. President, for all you've done and for your leadership to get us here. Our nation is in a full-blown housing crisis. Okay. Across rural communities, small towns, suburban neighborhoods, and major cities, home prices are sky high. Rent is through the roof. And just last year,
rent is maybe perceptually high. It has been negative nationally for like 2 or 3 years.
It's also, she's seemingly focused primarily on the home, like trying to get homeowners, people to buy a home. Mm-hmm. And I think that there's maybe a disconnect on what it takes.
Like you need housing, like the form of housing, own, rent. Do you ever really own your home?
So just maybe a disconnect between, the life that she lives and a down payment, the sizable chunk of cash that people need to be able to put down.
This comes back to the whole idea of like you need to own a home. It's not owning a home is great. It's a great wealth building tool, but it's like get invested into assets. We talked about this a lot, but like you need to build your balance sheet of assets. I don't care if they're equities or whatever.
Foundational to build and then own your home because there's a lot of money required to own a house. So
like the barrier to buy an S&P 500 index fund is a lot less than buying a home. It's like almost like we want the mortgage industry to keep making money on homes. Anyway.
Median age of a first-time home buyer hit 40 years old. Housing is the single biggest purchase that most Americans will make in their lifetimes, but it is far more than that. Owning a home means building economic security. It's the #1 retirement plan for families across the country. Pay off your home and live on your Social Security. It helps people have the financing to start small businesses in their communities, and it is the main asset that families can pass down from one generation to the next.
She wants that to happen.
Owning a home affects the jobs you can get, the schools your children can attend, and the kind of communities you can live in. But for too long, The federal government has been asleep at the switch while the crisis grows. Hundreds of thousands of families are priced out of homes by private equity. Many state and local governments have too many rules holding back housing construction. Young people cannot buy their first homes. Seniors and veterans are being left behind. Homeownership is out of the reach of too many families, especially Black families. We need to act. And that is why I stand here today in support of the 21st Century Road to Housing Act. This landmark bipartisan bill will help tackle the root cause of this crisis,
which is supply,
by getting more homes built in every community across this country. It will make sure that families own those homes, not giant corporations looking to jack up the rent and squeeze every nickel of profit they can out of American families.
Anti-capitalist statement.
Clearly, but again, the big thing that is incongruent with what she's saying is, she's fighting for like the little guy, the low income housing individual, who can't afford to buy a house. But the people that like are on the margins of like renting or owning, which are definitely like solidly in the middle class, even like upper middle class. Yeah. This could impact them, but what it hurts is the people who are actually in most need, which are the people that are renting. Yeah. And that they have no savings. And that's the majority of individuals. They have no savings. There's no money for a down payment. Their closest bet is to get an FHA, an FHA loan where you can get use like a 3.5% down payment. Yeah. But even that, there's a lot of savings.
I would even argue too that the housing stock is old, and those are the homes that these buyers could potentially afford to buy. But on the back end, there's a lot more capital needs for those homes to bring them up to an environment in which you want to live or take care of. These build-to-rent communities is a great entry point for a family to move in into an affordable area and have elevated living conditions, well-manicured neighborhoods, safe areas. Yeah. It just feels like there's this disconnect of understanding of what these build-to-rent communities are actually providing.
Yeah. Well, I would even go a step further on the build to rent, but even the existing single family home stock that is older, why should renters be barred from renting those? Yeah, you think we look at it from the standpoint of like, the private equity is buying it and they're providing a house for someone to live in that may not have ever been able to get access to that neighborhood, would never have been able to access that school district. Sure. Because if every house in Carmel was for sale only, there were no rentals in Carmel, then no one would get to go to Carmel School District or pick your fancy school district. But if an investor goes in and buys a home and turns it into a rental, that allows a lower income individual to get into that school district. Right. Now, you can be a NIMBY and say, I don't want those kids coming up into my fancy school district. That's another argument. Yeah, which I would think from Elizabeth Warren's point of view, you would want the lower income white kid, brown kid, black. Well, it doesn't matter. You give the opportunity to get into the better school district.
There's this, the escape from poverty. That is an immediate opportunity for somebody's family and their offspring, their children to take advantage of an opportunity to go to a better school district, get a better education, and build upon that. But with this lack of rental stock housing in some of these maybe nicer areas, she's closing the door.
Yeah, they're closing the door. Well, I don't know if you want to watch more of it, or do you think we kind of have I feel like I kind of have.
I know what she's going to say. I think it's a great video. Potentially, we can link it for our viewers to continue watching if they want the whole scoop or see.
Well, there's some good rebuttals too, and Jay Parsons had another one on his podcast, and I'd recommend after you've obviously subscribed to the Gray Capital YouTube channel and like the video, hop on over to Jay Parsons, The Rent Roll, and he's got a great episode on it as well.
At the end of the day, this still hasn't passed in the House, and so it's still kind of up in the air for debate. But what are the likelihoods? What is your gut telling you?
I as much as I follow all this in politics, the procedural process of the House and Congress, when this goes up is it included in a reconciliation package? I mean, it's probably going to sit and get bundled up with something included in some large omnibus bill that will pass at some point, or it could be dropped. Hopefully it gets dropped, but typically the Senate is the hurdle, and it's passed the way that it's again passed in such a bipartisan manner. I mean, what else is bipartisan? It's like the Patriot Act was bipartisan. Yeah, that's the stuff that like literally is eroded. Like the country is like usually the most bipartisan piece of legislation that get passed. So it probably if unless people actually stand up and give their congressman a call and make it very clear that it's anti-American. It's against all kinds of values, not just capitalism, but also helping the needy and helping the people that need to get ahead in life. And so it's about as anti-American as I can think.
A few years ago, and I only know this because we've got that little townhome that I rent up on the north side, but the north side suburbs in Indianapolis, the municipalities put basically rental caps on percentage of household stock that could be made available through renting.
Yeah.
And I think they started to kind of peel that back a little bit and retract it. I'm not exactly sure what the causation or the rationale is behind that, but I do remember the municipalities up north wanting to put a cap on rental families or rental houses available because the demographic of homeowners, didn't appreciate or didn't love the idea of their houses next door or behind them always changing and having different families and maybe not knowing who was, living next door to them. But recent news articles here in India have actually showed that they're kind of repealing those policies and opening up the rental pool again.
It's good,
which is good.
There's no economics or science that says that those are good ideas. It's literally only people who are like, yeah, I don't like my neighbors seem to have changed a couple times in the last couple of years. I don't like that.
Right.
Or like, I don't like the brown kids at our school.
Yeah,
I don't like that. That's where that comes from.
Mm-hmm.
And that's the only arguments, and they're not good arguments, but those are the arguments. No one's going to say the brown kid piece, but that's what they're saying.
And then it's sad that gets to the city the legislature in the city, and it gets pushed through and it becomes policy. It's like, how does that actually get to that point?
Welcome to Carmel. You live in Carmel.
I do. Yeah, I sure do.
I mean,
And so a special little spot in Carmel.
I love it. It's great.
Come by the house.
It's something. So, that's putting pressure on the housing stock. So we're going to have, less build to rent developments. And that is going to decrease, future potential supply.
Yeah.
The other thing, and we'll just pivot here right now, is, again, cost of oil is not going down right now. It's been going up in quite a large way. For some reasons that we all know. We're at war right now with Iran, and it's not coming down. It's been picking up, and we said it was going to several weeks ago. It was really clear. There was absolutely no way that. I mean, at that point, it was the damage has already been done from the infrastructure. It's going to take so long to rebuild, and then there has been so much more that has been destroyed over the last few weeks. Not trying to give play-by-plays of what's going on in the conflict. But the reality is material costs are not going down because of the conflict. Material costs are going up because of the conflict. And every day that the Strait of Hormuz is closed, and every day that they can't rebuild the LNG facilities and the oil facilities and the refinement facilities and the helium extraction facilities and the aluminum pipeline, that increases the cost of pretty much everything, and especially building costs for apartments, for all kinds of buildings. We've done our analysis on our operator terminal here. If you've watched previous episodes, you can go back and look at what this is. But it's basically our Bloomberg. It's not a Bloomberg terminal. It's our own terminal that is specifically tuned for multifamily investing. I mean, just looking at, we've gone from $65 to now, again, it's $112 today per barrel. Mortgage rates are pushing up. Steel is up 20%. Aluminum costs are up 40%. Diesel fuel is up 45%. Gas prices are up 35%. Now, this, on the downside, this squeezes those renters that are in B and C class. I mean, everybody. It squeezes everybody, but especially those that are already kind of on the margins, that are already struggling to pay rent, that are already in that 25, 30+% rent to income ratio. They're going to be squeezed anymore, and it's going to be very difficult to push rents on workforce housing. And I don't think it's smart even to do so. We'll get into what our strategy is. So the short term is just more pressure on prospective renters because just their wallet is being just stretched way too thin because they still have to pay to go to work. Right. And then the input costs of everything that's plastic, everything that has some sort of petroleum product, which is like this and this and this and this and this and this
that
and this
gets-
and all this stuff.
The transportation of goods, I mean, everything will be impacted.
Just the cost of diesel itself. I mean, again, diesel's up 45%, and that's moving everything. So what does this mean, long term? Again, impacting throughout. I mean, so it's going to drive rents at Class A properties up because you're going to have limited supply of new construction. It's not going to happen right away, but over time, rents are going to go up much more than they were than we could have forecasted several months ago, because the supply, which has already been reduced significantly, the supply pipeline, we were still on track to produce enough new apartments to kind of at least keep things moving. We were going back to 2018 levels.
But it was contracting.
It was contracting.
Yeah, it's only going to contract more. And this will be latent, 2 to 3 years, potentially down the line. It will persist.
Yeah.
Just because obviously starts and deliveries are very different.
Yeah.
But you would seemingly think that the starts will decrease. And then overall in the next, let's just call it 27, 28.
Yeah.
Of the deliveries, you'll start to see that latent impact on deliveries to the new supply.
2029 through 2031, 2032, we're going to see very few deliveries. And I think those are the years where we easily could see some above trend rent growth, over 3.5% potentially. And again, a lot of this is just a duration conversation. And it challenges what the Fed can do if we do go into a recession, which I think is possible, given the price of oil. Then the Fed only has so many tools in its toolbox. Typically, they have lower rates to zero.
Yeah.
But if you've got inflation that's cooking, and we're actually in a true stagflationary environment, which I remember back in COVID, everyone's like, oh, this got stagflation, this inflation spike, and we're not going to see this type of inflation again. And people were saying, well, why? Because you'd have all the baby boomers saying, well, I remember when interest rates were 14, 15, 16%. And be like, well, okay, well, that was different. That was like an oil shock. That's not going to happen again.
Here we are.
Yeah, this is worse
Yeah, here
than
we are.
the 70s.
There's a lot of the variables in this equation that are being pressured.
Yeah.
Or have some pressure on them.
Yeah.
So something's got to give, and then how does that impact the rest of the equation? There's a sentence in there just above it, just to mention the increase in overall construction materials, and just taking a look at that. And then we were discussing before this, if you're a developer, whether it's in, let's just use multifamily for example, but really in any facet, if you're a developer, obviously maybe your pencil's down, but on the acquisition of stabilized assets, it's potentially a great time to start to be, pretty aggressive, but also, stay hungry. Pencils are up, pencils are writing. Let's take all this into account. And you mentioned this on Monday in front of our entire, firm, entire company. How is Gray Capital kind of taking in all of this news day by day, the volatility? What are we doing on our operations side? And then we'll talk about potentially what we're doing on acquisition side, because I know on the operations side, when we're managing a property currently, there's headwinds. Things are getting more expensive. Vendor contracts get repriced. We're now tracking rent growth kind of internally, repricing some of our units. What does it look like when you talk about trying to be conservative or tightening down on our operations?
Yeah. Well, we've been in a soft market for a while. We've been talking about this since Q3 of last year. And so we knew that things were already soft. Again, things haven't been this soft since 2022, and before then, really haven't been this soft since 2008, 2009, where we've seen so many consecutive months of negative rent growth. And we've got inverted rent rolls across a lot of different properties, across many different states, where you're renewing someone is actually higher than the current market rate. Now, this is really bad in the Sun Belt. In the Midwest, we've had positive rent growth, but it's still been very sluggish the last couple months, and went negative as you typically do seasonally. During winter,
deep winter months. But
the challenge last year was we never had the growth during the leasing season. We kind of sizzled out around April.
It started early and then just kind of fizzled, but
And so we're going to know a lot more up at the end of April. And we talked about this with Carl Whitaker on last week's episode. If we get back, or 2 weeks ago, if we get out of April, and we're not really haven't seen any rent growth, it's not going to be good.
trying to batten down the hatches and watch expenses pretty tight.
Well, and so that's where I don't want to wait until April to do that. I just think that there's a heightened risk, not certain about anything, but there's a significantly heightened risk for a recession due to the conflict. There's already a good argument, and operators already were being more defensive, and we got more conservative on what we were trying to achieve on some of our rents. Still achieving mostly positive rent growth, but we started seeing occupancy kind of decline, as most of the market has seen.
Yeah.
But now looking forward, it's very clear we need to take a absolute defensive posture. And so the focus is on, stabilizing assets. The focus is on stabilizing occupancy, net operating income, protecting the back door, and filling apartments up so we have to actually optimize net operating income so we can take advantage of the growth after all this. Because I am equally confident that because of all this inflation, like we saw last time in 2021, we will see a surge in rents. We have seen wages have been increasing the last couple of years, but since supply has been coming into the hose like a fire hose out of the spigot, we've basically rents have been flat or even negative. So there's been so much supply. As that supply faucet, spigot, whatever gets turned off, then you have all this inflationary pressure. It's pretty simple economics. Is the rents are going to go up, especially if people have some room to pay. And the people who are going to have room are going to be at the higher end of the rent spectrum today. Now, we may see some wage growth on the kind of the bottom quartile. Certainly need to. Those are the folks that, again, it's this K-shaped recovery that are going to continue to struggle with higher gasoline prices. And we're not doing anything to help them on new rental housing, Elizabeth Warren.
Right. Yeah,
so, there's just going to be even less and less supply of, more affordable, lowercase a, affordable housing.
Yeah. How concerned are you kind of in operations, maybe within our own portfolio, but kind of across the board as, goods and services get more expensive? Like you said, the equation for rent growth is right in front of us. There's going to be some upward, movement to rents. How concerned are you with collections and just having, if rents go up, you're saying wages are going up, things are getting more expensive. Well, you expecting delinquencies to increase, and what type of strategy? I know we implement a lot of really good tenant-friendly communication strategies and different payment options and avenues across our portfolio to kind of incentivize, whether it's a bi-monthly payment or just really just kind of incentivize and bulk up our ability to collect rent payments. But if all of a sudden, some of these tenants, they can no longer afford groceries, gas, medical, whatever it might be, all of a sudden, are you expecting delinquencies to go up? And how are we at Gray Capital and Gray Residential, again, being defensive to manage, that potential uptick in delinquency percentage?
Yeah, no, it's a really good observation, and it's true. I mean, delinquency is already up.
Yeah.
And it's not going to get better if gasoline stays at the price that it is, because someone's going to be forced to, one day they're not going to have gas in their car and they need to go to work. And so they're going to have the decision, do I find a way to get to work, put gas in my tank, but that's what I budgeted to pay rent. And then then a couple weeks later, rent's going to be due and they're going to be short a little bit. And they're going to maybe pay what they can or not pay and try to figure it out. And I mean, you see the cycle; it happens all the time.
Yeah.
So I don't see delinquency going down. So that's just the reality, just from like an organic standpoint. What you do about it. One is communicate. You don't just let the payment go through and you file an eviction a couple weeks later. You get ahead of people, acknowledge, hey, this is tough. Communicate with us early and often. We have a direct line we have a team here in the corporate office that all they do is deal with resident services, collections, not a little bit of collections, but delinquency, if you're behind on your payment, in addition to solving any other kind of issues, kind of good customer service.
Right. Flexible, solution-oriented approach. And
Exactly.
I've heard some of those calls, not obviously on the phone, but from just being in the office and being able to listen to our centralized team, field those phone calls. it does seem like we are really providing a very flexible, solution-oriented approach. And it's not, a blanketed approach. It really does kind of vary from maybe it's property to property or resident to resident.
You're resident to resident.
And it's a good thing to be able to hear because, so often you kind of get this, we're an owner operator and we cultivate communities, and then there's the other side of things where there's these landlords and they collect rent, and we're not the latter. We're definitely the owner operator that cultivates communities. But as you look at some of these economic factors and our forward-looking projection of some of the headwinds that families will be facing in regards to their pocketbook, rent is going to be one of them that gets, a little bit pressurized in regards to, can we afford this and can we continue to make this monthly payment? And I just see where this is going, and it feels like we've already seen delinquency tick up across our portfolio. But as you said, the A-class assets, they're not insulated, from this, but they're a little bit less exposed. And we've talked about in the past where these A-class assets, they just have so much value baked in with the amenities, weight rooms, workout facilities, pools, pool table, resident lounges. You will always be able to sell that value. It's just a matter of solving for occupancy.
Well, I agree. I'm going to touch on that first. Kind of going back to we're not working with residents just out of altruism.
Sure.
We're not just doing it because we're like we want to do. We do want to do the right thing. We think we are doing the right thing. We have a fiduciary responsibility to our investors. Responsibility to everybody here. We got to be profitable. It's a for-profit business. It's not a non-for-profit. But the reality is, if you evict somebody, it's really expensive to evict somebody. You have to go through the legal process. You have to then turn the unit. And often somebody trashes their unit when they're getting evicted. Not every time, but like
I've seen a couple of those. It's really sad. They get angry and mad, and then those damage charges actually end up going back on them, or a majority of it.
Yeah, you attempt to.
Right,
then,
correct.
And then they're even more in a hole, and then you can't collect, and then you get sent to collection. It's a bad cycle. And so so you're going to spend. So if you can save someone, and save means allow them a little bit extra time to pay, and if they can become current, what is the cost of that time? Which again, they're making themselves current. So the risk is they never become current. And you have another month or two that goes on their balance, and that's another month or two if you don't get rent, and then you have to turn the unit anyway. But the alternative is if you just move to eviction every time as soon as possible and don't communicate, you're going to incur those turn costs every single time. And that adds up to tens of thousands of dollars very quickly.
Right.
And so and then just again, looking at it from just like a good how you want to do business. And obviously we have a lot of units and we have to have systems and can't make special exceptions for everybody, but like how do you want to do business? And if you are dealing with a customer, not a tenant, but like if you're dealing with a customer and they are communicating with you of this is the plan, we're working through this together, this is what I'm going to do. I think there's a strong business case that in the right circumstances, with the right vetting, you work with that individual to get them current. You don't incur those extra costs.
Right. It's like the fool me once, fool me twice.
Yeah. Well, and that's the hard part because you get some fool me once and fool me twices. And then someone says that they were going to do it or they were trying to and something else happens or they just, we were wrong. That's the biggest challenge. And it's, you never want anyone to be evicted. But at the same time, people legitimately take advantage of us and use fraud and will lie and, are planning on just living there until they get evicted.
Correct.
So you have to first kind of filter those folks out. So, to your question of it's not necessarily getting better, but we definitely have to mitigate. So what then you asked?
I wanted to talk about just the A-class assets. The asset that we last closed on down in Greenwood, it's a beautiful new construction A-class. In a already supply constrained market, it's just take a look at that asset and just
So
how are we packaging in that value in times like this to where some of these B and C class assets would otherwise have, I would say, some significant headwinds. how are the headwinds either reduced and or maybe not as impactful at an A-class asset?
Well, I think you have a little bit more flexibility because you have a better product, and so that the better product you're gonna be able to command a better price. And when you have flexibility on break even of like you could actually reduce rents and still be profitable. In a reality where like a lot of like the B class apartments they've seen their rent come up over the years, and it's a situation where the gap between some of like the B class or B plus, A minus in the brand new construction isn't always that wide. And so like we looked at this deal in Fort, maybe I've talked about this deal before. Like we looked and the brokers know exactly what I'm talking about. We looked at these deals in Fort Wayne and loved it, love the properties. Mid 80s deals, 1985. And the rents are only $200 below the brand new Class A construction.
Right.
And so I don't know all the numbers for the brand new Class A construction, but let's say they could lower the rents by $100 if they needed to. If I'm now
you're $1,200 away a year from living at the place with a sweet brand new pool and
it's such
dryer.
A different environment. Like who you would like figure out how to make the $1,200 unless you absolutely didn't qualify, but you're so close.
Have a lemonade stand on the corner every weekend and you're good.
Exactly. It's what you'd figure it out.
You would.
But like you can command occupancy and you can fill the thing up. And you just have to you're optimizing for NOI, and you're not going to get the highest rent, but you're going to be able to get heads in beds. You're going to be able to keep revenue going.
Yeah.
Whereas if you're
service
B-class,
the debt, have some CapEx reserves on hand, and probably distribute as well.
Probably be distributing.
Yeah.
And then like when you have high occupancy, that's when you have control and you have more pricing power. Then you can push on rents. I believe this is going to be a challenging year in 2026. And there's going to be some headwinds.
Just on operations wise?
Yeah. Operationally, just from like a fundamental standpoint, there's still a lot of supply overhang. None of this inflation stuff helps. But I think that it gets darker before the dawn, and I think that whether it's 2027, mid 2027, I mean it could be the end of 2026. I think that's less likely now with what's going on. But certainly by 2028, we're going to see this supply pipeline legitimately, the delivery pipeline. There'll still be deliveries.
Should we call it a cliff?
No, I don't know. Well, some are. It depends on the market.
I know.
It's like it's like the rolling uplands of southern Indiana. It just So where we're going with this on operations, it's a time to be extremely defensive. Or at least that's the way I think what you should do. Batten down the hatches and maybe not lower rents. But when you're looking at your renewals, it's really on renewals. Like, how important is it to push your renewals right now? I would rather protect the back door, not push on renewals, see where you can get on market, because you never know what's going to happen on market. Take advantage of the leasing season on the market. Don't take advantage of your in-place residents. I would treat them like gold right now, make sure their work orders are being taken care of, deliver really good service, communicate. And if you tell them we're only increasing your rent by 2%, like they're going to be so happy, or 3% or zero. And then those are all leases that you don't have to re-sign. Those are all turns you don't have to pay for. So your operating costs go down. And if you do pick up some progress in the market, you're going to have units to lease. No, you're not looking at a 100% renewal rate.
Yeah.
Your renewal rate might go from 50 or 55 to 60 or 70, maybe a little bit more. But I would say be especially defensive on the renewals, be dynamic on the market leases, but don't get over your skis. And then on the non-operational side, this is the other piece of it, is on acquisitions, we're going all in. We're going to have an aggressive acquisition stance because we're seeing opportunities now. The market is coming to us, I guess is the way I would say it. We've been very consistent of kind of what we would pay for an asset based upon our underwriting and our return metrics and like our acquisition criteria. We've got to see a certain amount of yield, cash flow. We'd like to see a total return. and we've just been so far away. We went to the deal pipeline on the show a couple of weeks ago.
Yeah.
It's a good episode. You can see we were anywhere between kind of 10 and 20% below the market on like everything we offered. We've offered on 140 deals the last 18 months. We've won one. And it's just, we knew what we needed to see. We knew what we needed to hit. And we were obviously 10 to 20% below market. And what's happened recently, though, is we're still in the market. We're just consistent. We put offers in, brokers say thank you, but like you're far away. And what's happened in the last couple of weeks, all of a sudden, is we haven't changed. I mean, we've gone a little more conservative because of what's going on. We've taken those assumptions into account, but we're still in the market. And now the market is coming around because sellers are getting nervous and buyers are getting nervous.
Right.
So there's, when we compete on a deal, there may be 10 to 15 other people who like might throw an offer in. Maybe 5 of those are actually competitive. But now it's down to like 1 or 2.
We've heard in the past, I don't know, let's just use the 3-week time frame, some of our competitors that we often see in the same hat when they're throwing in an offer for a property. We've heard that potentially, they've gone pencils down or not underwriting or looking for new acquisitions. You also had mentioned that we are slightly more conservative in our underwriting. I want to talk about, there's obviously somewhere in the middle between getting aggressive on acquisitions and going pencils down. And I think that's where we are. And that includes some of that discipline in our underwriting. What's changed in the past, let's just call it a month, on how we're underwriting deals in regards to some of this current macroeconomics? Rent growth, let's just call it vacancy. I know we've kind of changed our perspective on maybe those 2 preliminary assumptions.
Yeah.
Also, maybe some expense growth changes as well, but kind of talk through how we're looking at the market and how that kind of comes across in underwriting without getting too specific, I guess.
Yeah, so definitely. Well, I mean, the most obvious is mortgage rates. I mean, obviously, treasuries are up. Therefore, we're paying more on the debt service. That is what it is, and so that kind of limits what one can do. And that's 10 years rent has been running. I mean, it's 4.35-ish today, 4.39. We got close to 4.5, where it was.
It was sub 4.
It touched, it was right around 4 to 4, 4.10-ish. It was like kind of like in a range of like 4 to 4.20 for a long time, like 6 months or so. It had been very stable. We broke out of that range, which means like it could go back to 5%, or it could stay at 4.5%, or right in between. I think that 4.5% is probably like the near term ceiling, unless something really crazy happens. But so then there's the vacancy and concessions. We're trying to bake in the more vacancy. We're baking in lower rent growth in certain years, all depending on the market. Like there's no general rule, and like we'll have some deals where we've underwritten 2% rent growth, some 0% in year one, some 4% in year one or 5% because like there's a structural reason for it.
I've just seen us go in underwriting, taking rent growth down in conjunction with or in parallel to vacancy going up. Which I think is a very disciplined approach.
Yeah. Well, especially if you think about like going back deal after deal after deal, we had much higher rent growth assumptions last year or 2 years ago, and now that they've kind of gone down, and so that's I think healthy for the market, because if you aren't projecting a lot of rent growth, that means you're not going to be able to pay that much on a purchase price. If you get really aggressive on your underwriting, sure, you can justify paying more because your returns look good, but just what are the probability of those things happening? So and I think it's worth qualifying when I say we're getting aggressive on acquisitions. It doesn't mean we take our rent growth from 3 or 2, 3 or 4 to 5 or 6.
Yeah, we're not out here chasing yield.
No, exactly. Right. We're looking for yield. We're looking for cash flow, but we're also not saying, well, let's do a huge value add. Like, good luck understanding where all those cost inputs are going to be over the next 6 months to 2 years to get a $200 premium. Good luck on that 1980s value add deal that's workforce housing. Good luck. I mean, again, 2015 to 2020, you could do that math and it was easy. You put the $10K in, you get the $200 a month premium. Pretty straightforward math. It's not as easy today. And so what we like is quality. We like in-place cash flow. We like, markets, submarkets with really strong demographics, income demographics, really good schools, where there's demand. Ideally, there's not a lot of supply. There's pretty much every market's got a lot of supply. So it's looking at the markets that have not as much supply, where the starts have come down, but they've also been able to absorb the new inventory over the last couple of years.
I was going to say just a healthy absorption. It might not need to be like largely impressive absorption. It's great if it is, but just healthy absorption and trending healthy absorption, where you can kind of see where all of a sudden there will be demand is steady, supply is coming down. Eventually we'll have that, the fundamentals kind of flip and have there be almost a supply deficit, potentially.
Exactly. Because all of us into those markets are showing a lot of demand, and the submarket looks pretty healthy, given it's experiencing more supply than it's ever experienced in the last 40 or 50 years. So in an environment where there's hardly any supply coming online, and none in the next couple of years, you would certainly think you're going to get more growth than you are getting today. I can't imagine you get less in a lower supply world. So that's the upside. Obviously, when that happens, it's not going to be tomorrow, but it could be soon. So we like Class A. We like the Midwest. Again, it's affordability. More and more, I'm seeing articles about just people talking about the Midwest, Indianapolis, Columbus, Ohio, and as people try to lay down roots and coming back to buying a home, if that's important to you, which it clearly is to a lot of people, it ain't happening in a lot of states.
I was maybe 3 weeks ago, we brought up an article that was basically like, where are homeowners and renters moving to? And it was, the moral of that story was that it is a search, a pilgrimage towards affordability. And there's a lot of moving into or renting in Midwest markets because of that. I asked Matt last week on the podcast, said, hey, you moved from Chicago to Indy. Talk to me about the affordability, because that's, it's a big selling point here in Indianapolis. And he was, basically just kind of flabbergasted at how affordable everything was relative to Chicago. And then, this past weekend, Indianapolis hosted the Final Four for the men's March Madness tournament. I saw all sorts of articles from, sports fanatics, basketball fans that were in town that just basically said, hey, Indianapolis should host this tournament every year. It's one of the most easily walkable cities. The food and beverage is pretty dang good, bang for your buck, affordable, good quality. We want to come back every year.
Easy to fly into, easy to get out of, nice to stay.
It's just I think people are kind of awakening to it a little bit. Seeing when you come to Indianapolis, Columbus, Ohio, Cincinnati, throw Lansing in there, just some of these Midwestern markets that we know so well, all of a sudden you can do some things here otherwise that you couldn't do in some of the major metros.
Agreed. I don't know if you've ever heard this, Griffin, but in 49 states, it's just basketball.
Man, have I heard that before?
But this is Indiana.
This is Indiana.
Okay, we can't forget to do the jargon bin, Griffin. This week, we have to keep going. Everyone loves the jargon bin. We're talking about interest only today, or IO, a very, I think, or often misunderstood topic. It's a little nuanced, and it's a double-edged sword. You ready?
I'm ready. This is also a timely topic, and I think it's a tool upon which, if you're not familiar with interest only, it is intimately associated with the financing or the debt being used for, specifically in our case, multifamily. An interest-only period, typically the lender will give you an interest-only period, which is duration of time. Within that duration of time, you're only paying or renting that money that you're borrowing. So I'm going to let you kind of go into explaining that in a little bit more of an elementary school fashion. However, I do think it's important to talk about that period of time that it exists.
So when you borrow money, there's typically two parts of the payment when you're paying the bank back or whoever you're borrowing the money from. And there's the principal and there's the interest. So the principal is like the money I borrowed, I'm going to pay some of that back. You lend me $100, and part of it is I'm going to take that amount and I'm going to amortize it. So spreading that whole amount out over a period of years, which might not be related to the term, but that's paying back like the money I actually borrowed you. But if you just get that money back, like you don't actually make any money, you just get your money back, right? So you need to charge some interest. You want to make some money because you're like letting your money go. You want to have it working for you.
Yeah.
So you're going to charge an interest rate on that money.
It's my fee for letting you borrow that money.
Exactly. It's the cost of your time, and it's the value of you not losing the money. It's your discount rate of letting it go. Where else you could get it, you think that that's a good discount rate and rate of return. And so on a very simple mortgage, you're often paying both principal and interest. I'm paying my interest rate to you, for a year's interest on $100,000 would be, for if it was a 5% interest rate, it'd be $5,000. I'm going to pay you $5,000 this year. But if I spread that $100,000 out over, call it 25 years, 30 years, I'm also going to pay you a portion of that original balance back.
That principal balance.
I'm going to pay that principal balance back. And so that's a larger payment. So what interest only is you only pay the interest. You don't pay any of the principal back. And so what that means for, layer two. So how does that mean for real estate? Very simply is you're just paying your interest rate. You're not paying your loan down. You're not paying the loan off at all. So why
keeps some money in your pocket.
Yeah. So there's good and the bad. The good thing is you're not paying the principal down. That means that cash that you would pay the bank, you're putting in your own pocket. And that's often the way I like to think of it. Because some people say, well, no, I really like amortizing the loan. I like paying the loan off. And it can be true structurally because you're making progress and you're reducing that loan balance, which reduces your risk. So it reduces your total principal that you owe the bank. I don't want to owe you anything at the end of the day.
Yeah.
And if that amount goes down, I'm taking less and less and less risk.
And as you pay down that principal amount or that principal balance, it's also a way to build equity in that property. Or if you're a homeowner, you have equity in your home because you have that principal balance payment that you're able to recoup at exit.
You essentially own more of the actual home.
Right.
Or at least on the cash proceeds that would be produced from a sale.
Got it. And as the interest only payment or the interest payments, that's money that you otherwise will never get back because you're paying the bank or the lender. That's their fee for allowing you to borrow their money to utilize it. So interest payments don't come back into your pocket, whereas principal payments have the potential to come back into your pocket at a sale.
Exactly.
Okay.
And so while the bank and the lender, they don't mind the principal being paid down because that also reduces their risk. Also, it reduces the risk that you're going to default and they're going to have to take over the asset. And they don't want to spend the time doing that. But their profit really is in the interest. And so the lenders will often offer an interest only period, which is a period of ownership. And it could be the entire term of the loan, but it's often several years at the early stage of the loan where you only have to pay interest. What that does, it allows for more cash flow because you're taking that, what would have been a principal payment, it's just flowing through as cash flow. And so if you don't do anything with that and it just sits in the bank, that might be okay, because again, you've got reserves over here versus paying your principal down. So where I go back and forth, what I've gone back and forth in conversations is a lot of people will say, I prefer the loan to be amortizing. I want the loan to be paid down. And while that's good there's no reliant on having excess reserve somewhere else to come in and solve a problem at the end of the day. If something happens over time, just the principal goes away. You've paid off the loan, you own it free and clear, and that's great. That's a position everyone wants to get to. But a more sophisticated way to think about it is, instead of handing that dollar back to the bank to pay down, I can hold on to that dollar instead, and I can invest that dollar.
You can do a lot of things with it. You can invest it back into the property.
Invest back into the property. I can distribute it. It's yours.
Right.
You have control. And someone who likes control, I like having control over the money. Yeah. And so I see it as it's like I don't necessarily, as long as I am building adequate reserves and I'm thinking about the picture and the investment holistically, I'd like to maintain the control and to control the funds. And so I like interest only. I also like cash flow, and interest only produces higher cash flow. Now, again, if you just distribute everything, you're not building up reserves, you could find yourself in a position of where, things could get skinny.
Right.
But some people, again, for safety and for simplicity, it's like, let's just amortize the loan and not worry about it. And that's perfectly fine.
I think in our case, in kind of this intermediate knowledge base of interest only, it really is a very advantageous tool to bolster the front load or bolster the front few years of cash flow distributions for our properties. It's also, a relatively good tool that also help us increase maybe capital reserves on hand. Just like you said, either you can distribute that or put it back into your pocket or the property's pocket. I guess the next question that I would have as we get deeper in the knowledge is the IO periods, this interest only period. Obviously, the bank is offering you this period of time and you can negotiate. What good does it do the bank to offer these IO periods? And how do you, as a operator owner, when we're sourcing debt, how do we negotiate longer interest only periods?
Oh, it's a really, really good questions. I mean, so, banks they're trying to, loans are their product. And so it's another way to incentivize people using their products. And it's a feature of their product. And for let's say a value add investor or really any real estate investor, typically cash flow is skinnier in the earlier years than in latter years. And so by having interest only in the first couple of years, at least, that allows you to, stabilize the asset, execute your business plan, and get your stabilized cash flow to a point of where all of a sudden that interest only, you don't necessarily need that cushion anymore. Then you can switch over to fully amortizing the loan, paying down principal because you've executed your business plan, you've gotten revenue and net operating up to a point where it can sustain that full amortized payment. Now, most lenders will size a loan not based upon the debt service coverage ratio of the interest only period, but of the fully amortized amount, unless the loan is a full term interest only loan. So that's like if you're taking out a 10-year loan and they're offering 10 years of interest only, which typically only happens if you're a really good borrower, and typically with a lower loan to value. And so that's where the negotiation comes in, the second part of your question. There's a couple of different variables. The more money you borrow from a percentage of the value of the property, most likely the lender is going to give you less interest only. Because they're saying, look, you're taking a lot of risk. You're leveraging this thing up. We really need you to start paying that down because you're already making us uncomfortable.
So a lower LTV or loan to value would give you an opportunity to negotiate a longer interest only period.
Yeah.
Okay.
Because you're like, look, I'm only asking you for 50%. I'm going to, it's the golden rule. The one who has the gold makes the rules.
Yeah.
And in this case, it's usually the lender. When the lender is saying, like, you want to borrow how much? 80%?
Yeah.
85?
You're going to do it on my terms.
Okay, you're going to do it on our terms. You have to start paying that thing. If you want them, you have to start paying that back right now. Versus, we're going to bring 45, 50% of the money. Now, lender, you're going to bring another 50 or 60%. We don't need you. We want you in the deal, but make us an opportunity. And they're like, wow, this has a lot of room. This is safe. This is low risk. You want some interest only? Sure.
You want
that
our
sounds good. We want your business.
Yeah.
You're obviously a good borrower. You got deep pockets. And those couple of years of interest only are going to help because you've got a low leverage deal. It's going to make your numbers work. So it's all, risk tolerance and risk assessment from the bank. And I'm not a banker, but that's typically the way they're thinking about it.
Interesting.
Yeah.
It's a kind of an interesting tool to take a look at in terms of kind of negotiating with our debt quotes. Each one of them seemingly a little bit different. Which one plugs into each acquisition model and provides the most realistic, palatable, advantageous economic result for our investors, for Great Capital as a general partner. It's kind of like having all these different debt relationships. Which one can bring the best tool to that deal to kind of fit into that puzzle? Yeah,
there's rarely a right or wrong, option. It's preference, and there are some, I think, more right than wrong options. But again, but very simply, the more interest only you get, higher cash flow, lower IRR, lower total return, because you still have that balanced payoff at the end.
Yeah.
But the way IRR calculates, if you front load the cash payments, you typically, again, your principal at the end of the day is lower, and so you have more proceeds at the end. You have higher cash flow, but lower IRR during IO. If you are not using IO, higher IRR, lower cash flow.
Right.
Even though that there's higher cash flow in earlier years.
Just taking the LP lens, you're looking at a deal, you see, pretty palatable, very advantageous cash flow in years 1, 2, and 3. You're very excited. Like, wow, that's a great deal. But then you notice in year 4, 5, and 6, it kind of takes a drawdown, it takes a large step down. You're trying to answer the question, what the heck happened to the cash flow? Why is the cash flow going way down? Well, the IO period burned off. Now we're also, that loan is beginning to amortize. Now you're paying down that principal payment. And while
it's like training wheels.
It's like training wheels. While it looks like, your cash flow is decreasing, but you're also building that equity through those principal payments. And so at a refinance or a sale, that money is indeed coming back to you as the investor. You would hope. Certain circumstances, maybe it wouldn't, but
sometimes, and that you bring up a good point that I push back on sometimes. It's fine. Is that I've seen some operators and even some LPs will look at the amortizing period, and they'll take their principal and they'll include that into their like return metrics and they'll say like, well, it distributed 4, but we're paying principal, and so it's actually like an 8% return. It's like we're paying it down, so like you'll get it eventually, and it's like, yeah, you probably will get it eventually, but you didn't get the money now.
No,
and so like I'm like I just ignore that. It's cash on cash, whatever the deal actually distributes and produces, or look at net cash flow also. But like just because you're paying down your principal, again, it's you're improving your balance sheet. But improving your balance sheet is different than a return.
Right. I think it's just an important thing for LPs to be kind of acutely aware of is the mechanics of cash flow and how it gets equated and how you get to that final number. But also when you see some of those large changes in a forecasting model or an underwriting model to where cash flow is decreasing or increasing pretty drastically between a 1 to 2 year period, start to ask some questions to better understand what that IO period looks like when it burns off. There's other implications that it can have on the deal in regards to your overall returns that I think is worth investigating. We get that question all the time. Why is the cash flow changing in year 2 and 3? Predominantly, and more often than not, it's likely due to an IO period burning off.
Yeah, exactly.
That wraps up today's jargon bin.
Just to wrap things up, it's an uncertain world. Whether we're talking about the war, or oil, or politics, and we didn't even talk about AI, which is what everyone's talking about. What makes sense and where you can find certainty is what everyone is still going to need, whether everyone's vibe coding or we're at war and it's a place to live. Shelter will be in demand. It's still going to be rooted between supply and demand. Maybe questions at some point of who's paying for the housing, but people are going to need to be housed. And the defensive nature of multifamily right now, I think, is going to shine. Real estate has been out of favor for the last couple of years, and it is starting to turn, but hasn't fully turned yet. And I've dedicated the last going on 12 years of my life just looking at multifamily, looking at the markets. Learned a lot, made mistakes without losing anybody money, but learned a lot. We're building a lot, and I'm more excited right now, not because everything is like I want things to happen in the world and I want a war. It's the last thing that I want. I don't want that piece of legislation, but a lot of the reasons why I'm in multifamily isn't because I think that, great, there's going to be a limited supply of housing, but there is just looking at the reality of the market in the world and saying that housing is going to continue to be in demand, and it is an asset that is going to grow, and it's not going anywhere anytime soon. And so it's hard to put a finger on where the S&P 500, where even gold probably going up, where Bitcoin, where fix, where oil, I don't know. But Griffin, I'm very confident that in 5 years from now and in 10 years from now, the multifamily properties we buy this year are going to be valued significantly higher. And the rents, for good or for bad, are going to also be significantly higher. And while everyone is sitting on their hands and is concerned and confused, I want to take advantage of that because I have a responsibility to our investors to find opportunities that are wedge cases, to find good deals. I have a responsibility to you and everyone that works on the Gray team to be able to find opportunities to pay everybody's salary and keep the lights on.
Right.
While marrying those two things, because they both have to be true, it has to be a good deal that doesn't lose anybody money and ideally doubles their money, over a 5-year period, if not more. I have a moral imperative to take advantage of this situation and exploit it in the most moral way possible, but as a market participant to go find the best assets in the best submarkets with the best demographics and to acquire them at a price that is going to produce long-term returns for our partners and myself and for you.
Yeah. Exactly.
And so that's exactly what we're doing
Well said.
right now.
It's well said.
This is a sneak peek. We can't give away too much, but we are close to having a new opportunity for Gray Capital investors. Can't give away anything out, but it is the right deal for the right time in the right market, producing more cash flow than I have seen on a deal in years.
And if you want to find out the details the moment that we can share them with you as an LP, the best place to access this information is the Gray Capital Investor Portal. If you go to graycapitalllc.com, in the top right-hand corner, you can sign up and or log into our investor portal. Do that, you'll gain access to our investor deal room. And when this becomes available for dissemination, every single detail for this deal will be openable, accessible at your fingertips in the deal room.
Yeah. And the only difference between this deal and past deals, and again, I don't want to give away too much, is we haven't had a deal in a while. It's like going on a year.
Pretty close, yeah.
And
really close, actually.
We're in active conversations with a handful of groups that would just want to take the whole thing. And so, but we're going to reserve we're going to reserve a chunk for current Gray Capital investors. And so if you're somebody that has reached out to if you're an existing investor of Gray Capital, obviously you're in. If you're somebody who has been communicating with us, you've introduced yourself to the team, you don't have to, do a whole thing, but just, hop on the website, maybe schedule a meeting or shoot us an email. We can put you on the list. Now, maybe all of our big investors just decide to drop, and we're gonna be pitching everybody. Maybe that happens. But if you want the best chance of getting into the deal, you got to get in touch with us earlier than later, because we'll do a soft launch to folks that are inside the portal before we put it out to the public.
Correct.
And this is one that you're not gonna want to miss because the cash flow is so good. I mean, if the IRR is not that high because we're discounting quite a few things in the deal, the cash flow is incredible.
What'd you say the other day in the office? It's like buying a bond, but it's got upside.
Yeah. I mean, it's that level of risk. It's like buying a corporate bond, but you have this huge equity kicker on the top.
Yeah.
You're in the first position behind the bank. You get a preferred return, equity upside, vertically integrated operator that, probably my family office, we're going to be investing 14-20% of the overall equity. We're going to be probably the largest, if not the second largest investor in the deal.
In an exciting market, too, that we've had eyes on.
Spending years trying to get into this market.
Yeah. GrayCapitalLLC.com. Sign up for the investor portal. Book a meeting with myself or Blake. We'd love to chat about it with you as much as we can and be the first to get that information on our investor portal. Put your name on the list. We're excited for this one. We hope you are as well.
Yeah. All right. See you on the next week's episode.